right, welcome back. So let's take a look at periodic sales. Okay. So as we talked about this in the very beginning of the chapter, or in the very first chapter, I should say, we talked about the nature of a business. Our main goal as a business is to take raw materials and convert them or to create either a product or a service to consumers. All right. Now, of course, when we talked about purchasing inventory, right, that included things that it's going to cost us to either obtain or to produce the product itself. Now, again, the main goal of us is to sell something and also at the same time receive some kind of profit. All right. So when we talk about selling goods to the public or selling goods to anybody, we have to figure out what the selling price is. And what the selling price usually entails is selling the product, right, for the cost that it is plus a small profit percentage. All right, because the whole purpose of getting a profit or to gain money is to find some kind of way to sell the product out to your customer, but at the same time gain extra money on top of it. All right, you never want to sell your products at cost because then, the money that you spent, you never want to zero out yourself. You never want to break even because then you will, if you ever break even, then obviously whatever that you, when basically if you sell your items at cost, right? Not only are you selling yourself a little short here, but you're not making enough money to be able to cover all the costs it takes to operate your business, right? There's more than just selling the product. There's rent, there's insurance, there's advertising, right? Those are all going to be considered business expenses that you must incur in order to operate your business. And in order for you to be able to successfully make a profit, you need to set some kind of selling price that allows you to achieve to not only cover the cost of the product itself, but to also cost the other expenses it takes for you to run your business. So again, that's the purpose of sales, right, of any business. We want to try to make some kind of profit, right, earn some money, but at the same time minimize our expenses, right? We're going to sell our product for cash, and usually these two factors are going to be contributed. One portion is to the actual cost it takes to obtain the item, which that's exactly what we did yesterday, right? We calculated the cost it took us to sell the item. And then on top of that, our selling price is going to include some kind of profit percentage. So it could be 40%, 100%, right? If I buy an item for $1 and I go back and sell it around for $5, that's a 400% profit right there. All right? That's what I mean though. And of course, for this class, right, because we are looking at being a retail kind of business, right? We're looking into merchandising. We need to consider the fact of sales tax. Now, once again, sales tax is going to be based on the state and the local area, the county that you belong in when doing business, okay? So for this class, I just want to make it real sweet and real simple, and I want us to just focus on 8.25%. Okay? So no, because right now the idea of sales tax, right? It really depends on where we go, what state we belong to, and exactly which county that we belong in. So in this case, this number could change, could be different, could be completely different. Maybe some states don't even charge sales tax. All right, but I want us to practice because in the state of Nevada, we do charge sales tax. All right, so for this class, I want you to know 8.25%. Real simple numbers. So once again, when we talk about periodic inventory, right, we notice that we don't actually really care for sales, right? When we're doing our periodic inventory, we really focused on just purchases, okay? But let's see what happens when we have periodic sales, right? So once again, here on June 1st, 10 items were sold at $9.99 each, and tax was 8.25%. Record. So here, we're going to be looking at two accounts. We're looking at sales, pretty straightforward, and we're going to be looking at sales tax payable, right? And of course, one thing that we should always assume, all right, if you're selling a product, what should you be receiving? Cash, credit, any forms of payment. You should be receiving money, all right? So in this case, right, what we know about sales is what type of an account is sales?
Is it accounts receivable?
Okay, so what type? So remember there's 5 types of accounts. So what type of an account is sales?
That's revenue.
It is a revenue. So you will always credit your sales. So in this case, right, if I sold 10 items at $9.99, what should be my total sales?
99.9.
$99.90, correct? And then sales tax, right, is going to be based off of the percentage, right, of your total sales. So here we recognize that we are going to be receiving cash. We recognize that we have sales, right? Sales is $9.90, right? And then tax is going to be 8.25% of $99.90. So tax, if you actually know what tax does, it's based off of your entire overall amount that you sell. Okay? It's not based per item, it's based on the overall total, or in this case, subtotal of your sales. So in this case, I take my $9.90 and I multiply by 8.25% to get $8.24. So in this case, right, my grand total of cash that I'm going to be receiving is going to be $108.14. All right. Now let's take a brief second and talk about sales tax. Why is sales tax a payable or a liability?
Not income for us.
Okay, it's not income for us. Why is it not income for us?
Because we're going to pay it. It's actually payable to the tax division.
Correct. We collect, because in order for us to do business, right? If we're open up shop, we are mandated to collect sales tax if we sell a product. All right? If you provide a service, you're tax exempt. However, when you sell an actual product, right, whether it's electronic or anything like that, you are obligated to collect sales tax from the customers. And what you're responsible to do is you're supposed to take that money from the customers and you're going to send it to the government. So whether it's state or local, okay, depending on how the tax is divided. Okay, now we'll go into more depth about sales tax in QuickBooks. But for now, we know that we understand if we're going to be open up shop, we need to collect sales tax. So that is not part of what we earn. This is part of what we owe to the government. So in our books, we must separate it, okay? But in the customer's perspective, they're not going to give you the sales and then they're not going to give you the tax money afterwards. No, they're going to combine it to you and you're going to, just as a cash register, right? You're going to receive the entire amount, give them back their change. However, in our books, you must make a clear distinction between the sales of the revenues that we earn and the money that's going to tax at the end of the day that we need to collect to give to the government. Okay, so this is exactly what we have here. We have cash / accounts receivable, right? Because this is what we should be getting from the customer, right? If a customer decides to give us cash, that's cash. If a customer has an account with us and say, I'm going to use my store credit card or I'm going to place it on an account, then that's going to be considered an accounts receivable, right? So again, making sure you know the difference between accounts payable and accounts receivable. Accounts payable is when we owe to vendors, where accounts receivable is where customers owe us. All right? It's in another sense, they're like IOUs, right? They promise to pay you back within X amount of days. All right? So that is how we journalize a sale. Now, once again, sales is permanent. It's finite, okay? Meaning you cannot undo sales, right? Once you sell a product, it's sold, all right? However, we'll talk about in a few sections later, what happens when a customer returns stuff, all right? But in this case, this is exactly what we have to do. We recognize that we're going to be receiving something from the customer. We must recognize the amount of sales, so what the actual product we sold was for, and we also have to calculate the amount of tax we're going to be collecting from our customer. So, any questions here?
No.
Because that is it for 6.1. Right? Now, here's a little note that we're going to be understanding here is that under the periodic inventory, we do not recognize or care about sales or calculating the cost of goods sold when we're dealing with periodic inventory. Because why? Because what happens at the end of the given period? Under periodic inventory, what do we know? What happens at the end of the given period?
It's closed out.
Okay. All right. More specifically, how do we know what we sold? All right. So if you guys remember, go ahead.
We may have an ending inventory.
Right, because the main purpose of having a periodic inventory is the key factor that someone's going to go down to the basement and take a physical count, and our assumption is whatever we don't see in our inventory, we assume that it's been sold or it's been damaged or it's been got rid of. So in this case, we never keep track of our sales. So every time we said right here that we sold 10 of those items, right? In our journal, we don't care to keep track of it because at the end of the given period, someone's going to go down to the basement and say, "Hey, you have 90 items left." So therefore, the assumption is you already sold 10 of them, and we do what's called a conversion entry, right? We actually enter in the items that we actually sold and the value, and we adjust our inventory that way. Okay, so under periodic inventory, we do not recognize or keep track of our inventory when we sell the product. All right. Any questions here? All right. Moving on to 6.2. All right. So let's take a look here. Well, of course, when we sell a product to our customers, we have to understand that not everybody is going to be satisfied with the products that you sell. So here, if we do sell a product, we have to assume that we are going to have those customers that are going to be who are unsatisfied with the product and want to return items back to you. All right. So many reasons why people can return a product is because maybe they bought it, they took it home, and they found that it was defective. All right. Or maybe it's kind of broken because it's in the package. Right. So there are many reasons. It could be even that they just don't want it anymore, or they're just unsatisfied. So many people that buy gifts for other people, that's usually a common reason why you're more likely to get a return or an allowance. Because in this case, right, it's a product that they don't like. They want to return it. They want to exchange it. Okay. Now, of course, with that being said, you must set some kind of company policy to that kind of prevents your customer from having unlimited returns on your products. Because at the end of the day, your goal is to sell a product and keep it sold. You never want to allow all these unlimited amount of returns, etc., right? Now, of course, your company policy could entail things like you can issue a full refund within a specific amount of days, right? So common ones that you'll see normally are 7, 14, 30, 60, or even 90 days, right? Right? We know that QVC, they want you to use the product. They want you to use it, and they give you up to the maximum days of 90 days to return. And they said money back guarantee. If you don't like the product, send it back to us within 90 days and we will refund you, no questions asked. Even if you send them back the product completely used, okay? That's their company policy, right? So you need to make some kind of company policy that works best for you. Now, of course, if you're a small business, you kind of don't want to be able to allow a customer to be able to give you back a product within 90 days. Okay, so like I've said, it could be most common ones I've seen so far are usually 7 days, so that you give them 1 week, or even 14 days, or 15 days, etc., right? You might even have a store policy where you won't get a full refund, but you'll get a store credit. Okay, it could be final sale, or you can issue a new product. So let's say someone brings in a product, you can exchange it for no cost at all, right? Even exchange, right? And also, etc. So there are many things that you can come up with a policy to be able to keep the customer satisfied, because that is your goal. Your goal isn't because if you want to keep your product sold, you must keep your customer satisfied. All right. So once again, whatever your company policy that you decide you would like to implement, make sure you go through it, because the main goal, right? If our goal as the nature of a business is to take a product or get natural resources, raw materials to create a product or service, you want to keep those items sold, okay? Now, of course, if we charge our customer sales tax, you are obligated to give them a portion of the money back if you do full refunds, okay? Because once again, that's not your money, right? It's money that you collect from the customer that you owe to the government. So, because if they decide to return the product, you have to assume as if that transaction never happened, right? So, therefore, you must give them back the amount of money that they're getting a refund for plus the tax that they paid into the government. Okay? So, once again, sales returns and allowances, right, is based off of how you want to have those restrictions and as well as your company policy. All right, so let's go ahead and take a look at our very first example here. We have to record a sale in the first place before we can return the product, okay? So first things first, here is example is on May 1st. You sold 50 coffee mugs for $5 each, okay? Sales tax was 8.25% and customer A, right, pays you with cash for the mugs, okay? So let's go ahead and think about how we're going to record this transaction. So right here, exactly what we practiced from the previous section here, I want to record my sales. So we're given cash, right? And we're given the sales and we need to calculate the tax on there. So what is my journal going to look like?
Okay, you'll have your date, May 1st,
Mm-hmm.
and then you'll have the description, 50 mugs at $5 each,
Okay.
um, which come to a total of $250. Oh,
Okay.
okay. So you'll put you'll have a credit of 250
Okay.
and a debit, right, of 250.
What about my tax?
You'll add your tax. Your tax payable would be what, the 8.25 of $250,
Mm-hmm.
$20.62.
Okay, so then what's my total debit then?
What's your total debit?
Mm-hmm.
It'll be the $20.62 plus the $250, 270.62.
All right, so in this case, right, we're going to recognize that we are receiving cash, right? Because that's the initial transaction here, is that I'm increasing my cash flow, right? I sold a product, so therefore I'm increasing cash. I'm also sold something, so therefore I'm increasing my revenues, right? And exactly what you said here, right? We're going to take our 50 coffee mugs and multiply them by $5 to get $250. Now, rule about tax. Tax will always round up. So I believe in this one, I believe it's 6 to 5. So you're going to round that up to 63 cents. All right? And once again, you'll be receiving a grand total amount of $270.68. All right. 63 cents, I'm sorry. So that's exactly correct. So here we go. Now let's take a look at scenario 1. Okay. If customer A, all right, on May 10th decides that they want to return 10 of those coffee mugs for a full refund, right? And your store policy excuse me, was to grant a full refund within 15 days of the sale. Okay, so in this case, we are going to be recording this transaction, right? Because she returned within 15 days, right? It is May 10th. We sold the product originally on May 1st. So in this case, she does meet our company policy, so we are going to grant her for a full refund, all right? So, as I've mentioned before, sales, you cannot undo sales. So in this case, what do you think we should be doing? And what is the idea behind this? Right? If customer A is going to return 10 mugs, okay, for a full refund, how do you think we should record this?
Okay, if they return 10 mugs at $5 each, they'll get back $50 plus what they paid in taxes.
Okay, so go ahead and calculate that.
So, the date, then the
Mm-hmm.
description is that a return or allowance, or do you just put return and allowances?
That's exactly correct. In this case, we are looking at sales, returns, and allowances. In this case, right, we talked about how a return and allowance are the same thing. And we'll talk about allowances right after this example here. So here is a return, for a full refund. So you're going to recognize sales, returns, and allowances. Good. How much is the tax?
8.25%
Okay, so what are you going to take the tax on?
on the on the on the items on the 10 cups at $5 each. Oh, she doesn't get back the full, so she'll just get back a portion of the tax, but only on 10 mugs.
Correct. So what is that amount? Go ahead and calculate that.
Okay. 50 times 8.25%, $4.12.
Good. And what's the assumption? How did customer A pay us?
She paid your refund. Um, I don't know. Was it on credit?
Let's see, let's go back to the previous one.
So, so 50. Oh, she paid with cash.
She paid with cash, so therefore we're gonna recognize sales returns and allowances, right? Because once again, sales returns and allowance is going to now act as a contra account to sales, okay? So here we understand that we're making a sales returns because customer A is attempting to return products, right? They're returning back to us, okay? So therefore, we're going to recognize the account, sales returns, and allowances, right? We're also going to give them back the amount of tax that they are subject to be receiving back, right? And exactly what Kim said. It's only a portion of the tax that they paid into because they're not refunding the full amount. You know, they're not refunding all 50 mugs. They're only refunding 10 of them. Okay? And of course, how they pay us was cash. And exactly how you calculate it, right? If she's only returning 10 of them back, 10 times 5 is 50, right? And then you take that $50 and you're going to multiply it by this tax in order to give that small portion of the tax back to the customer. So in this case, right, I'm calculating because now I don't owe the government money anymore because that's their money. So therefore, I'm going to give them back a grand total of $54.13. Okay?
I have a question.
Yes.
I keep coming up with like 1 cent off. Like I came up with $4.12. Am I calculating it wrong? Because I'm
No.
not putting in the 0.0825. I just put in the 8.25%.
Okay, so I don't know because that's a calculator issue, but you may need to format your calculator to show you um, at least 4 decimal places.
Okay.
So it could be because you're entering, but I don't know why your calculator doesn't round off automatically.
Okay.
But in this case, because if you actually do extend it out, it's actually 4.125.
4.12. Okay, yeah, I must be off on my on the decimals where they're going.
Mm-hmm.
That's why I need to go up one more. Okay, I got
Mm-hmm.
it.
Well, again, it also depends too because it depends on what the number is. Okay. So there we have it. That's exactly what we're going to do. We're going to recognize as sales returns and allowances. Okay. Now scenario 2. Okay. So let's say it is now May 18. All right. So scenario 2 shows us that they didn't return the first one. Customer A wants to return 10 coffee mugs for a full refund, right? But however, the company policy was full refunds. I'm sorry, I'm reading the wrong one. So in this case, okay, they want to return coffee mugs for a full refund, right? Because the customer decides to say, I don't like the color, all right? And you tell them that the customer, that they have missed the return policy, right? Because we said that they have to return within 15 days. They've missed it, right? It's already the 18th, all right? And then in this scenario, um, so at this point, right, they lost the opportunity to get us full refund. However, right, we talked them into um, getting an additional 15% because they don't like the product, right? And they're complaining at our store and or they're making a scene, because they're mad. They're saying, I want a full refund. I don't care about your company policy. I want a full refund. And because we're trying to keep this customer to come back to our store, we decide to give them a 15% discount. So in this case, we give them an allowance, okay? Now, again, allowances only commonly happen when you are a smaller type of business where you can haggle your prices for most cases because as a small business owner, right, every customer you want to keep them as much as possible, but as a corporation you don't care if they're their customer or not because you have a million other people that will buy your product, right? In this case we're trying to build our brand, so if we lose this customer, that's it, that's one person that we lose out. So you want to try to give them any incentive to keep them to come back to your store, so you threw in an additional 15% discount. So in this case, how are we going to record this transaction?
You're gonna debit sales returns and allowances for $7.50.
$7. How did you calculate that?
I took the $50 times the, oh no, sorry, yeah, the $50 times the 15%.
Perfect. All right. And then as a sales returns allowance, even though they kept the product, right? We said, hey, I'll let you keep the product. I'm sorry you don't like the color, but you already missed our company policy. So you get to keep the products. Even though they get to keep the products, right? Do we need to give them back their sales tax money? Yes or no?
No.
Okay, let me ask that again. If
Yes.
we let
Yes.
them keep, okay, yes, good. The correct answer is yes, because at the end of the day, right? You still sold the product to them. Tax is only based on the actual total selling price. It's not based on about the number of units that you sell. So even if though you let them keep the products, you are subject to also give them a portion of the money back, because once again, it's based on the whether you sold the product or not. In this case, they're keeping the product. So that means you definitely sold the product to them. So therefore, even though you're giving them a 15% discount, sales tax is based off of the total amount of selling price. So in this case, you do need to give them that tiny small portion of their sales tax back. So in this case, right, it's like as if you sold the product to them at a discounted price. You're still going to charge them sales tax no matter what. So in this context, right, how much tax are you going to be also giving back to customer A?
8.25%.
Correct, which is how much off of 750?
750. 0.61875. So what? $6.19.
Not $6.
61 cents.
60,
62 cents.
62 cents. So once again, we will be introducing, right? In this case, right, in context, we are dealing with an allowance, okay? We're dealing with a sales allowance because we're not giving back, or in this case, the customer is not giving back the product, nor is the customer going to be getting a full refund, right? They're keeping the product and we're just giving them a portion of the money back. So that's going to be considered an allowance. So once again, the idea of the idea of sales returns and allowances, they function the same. All right? So in this case, I have my sales returns and allowance. We talked about this. You are mandated to give a portion of the tax back. And of course, she paid with cash, so therefore, you're going to be calculating this right here. $7.50, right? You take the $50 or the 10 coffee mugs at $5 to get $50, and you're going to calculate the discounted amount, which in this case is 15%, which you're going to refund to the customer. And based off of that $7.50, you will calculate the tax, which is 62 cents. So therefore, in grand total, the customer is going to be walking away with $8.12. Okay. All right. Good. Excellent. Any questions?
No.
That's it for chapter 6.2. All right. Now, we're going to dive right into dealing with discounts, okay? So, sales discounts, right? Every store has some kind of discount offers, all right? This discount sales, right, is a way to entice your customers to want to come in and buy your product. Because as a consumer, right, everybody's looking at how can they buy a product for not full price, right? If there's a sale going on, they're more willing to want to spend that money because their dollar can purchase a lot more items than it is if they purchased it at full price. So again, grocery stores, clothing stores, always they'll have some kind of weekly ad or some kind of sale of the month or whatever it is, right? To entice customers to come in and buy their product. Because, like I've mentioned before, not many customers are willing to pay full price. Okay? So, of course, with that being said, right, you have to do some kind of way to let your customers know by having promotional sales, grand openings, or even a weekly sale or a store-wide sale, right? The whole store is 40% off, right? Or you can even offer online deals, right? Because, with the idea of COVID, right? Everywhere else, you buy now online, I will give you free shipping, all right? There's lots of ways that companies can entice customers to want to come into the store and buy their product. All right. Now, again, when we're looking at these types of discounts, right, there's also other discounts that you can also do. It doesn't have to be in-store discounts. You can even offer for example, you can even offer any of your customers that have accounts with you. So if they owe you money or they have some kind of credit with you, you can offer them exclusive discounts as well, right? So most people who are, they sign up for their mailing addresses, right? They get additional, coupons or, special offers that not everybody into the public can actually get. So those are going to be considered other special offers that you can offer your customers as well. You can even offer as a wholesaler too, right? If they're buying more than one item for you and they're buying in bulk, you can also give them a small discount on top of that too, because they're, a huge contributor to your sales. Okay. And of course, we'll talk about terms too, because if you guys remember from chapter 5, if a vendor can offer us as a customer terms, we can also, as the store, also provide terms for our customers too, because the idea is that it's another incentive to get our money back quicker. Okay, so that's the wholesale discounts here. Let's see. Once again, let's go ahead and dive right into our first one, which is our in-store sales. Okay. So here, where we have on June 1st that your store have a promotion on all items are 40% off, and a customer decides to buy 10 baseball hats, okay, with cash, okay, with the original price that's selling for $10 each, okay. Sales tax is 8.25%, and how are we going to record this transaction? So once again, if sales, right? Think about when you go to the store and you're taking a look at your receipt when you buy a product that's on sale, okay? And kind of apply it here. So when we talk about an in-store discount, right? We're looking right now 40% off of those 10 baseball hats. So how should we record this?
Well, we know we're receiving cash.
Correct. Okay, question to you. Now, you said we're going to be receiving cash, right? Are we going to
Yes.
be receiving cash for the full amount or for a discounted amount?
The discounted amount.
Okay, perfect. Good.
So we'll be receiving $60 for the hats plus the sales tax,
Plus the sales tax. Good.
which is $4.95. So we'll be receiving $64.95.
Okay. Good.
Well, I know we're gonna credit the sales tax payable for $4.95,
Okay.
so I'm missing something in there.
You're missing two things.
So it would be, you would, record it as the full price minus credit the $4, I think she said, and, then add the 8.25%, is that correct? Correct?
Okay,
Minus
so
the 40.
you are on the right track. You are going to record it at full price.
Yeah, and then credit the 40%, and then credit the 8.25%.
All right.
Is
Now,
that right?
okay, so in accounting terms, in English terms, I understand exactly what you're doing in English terms, but in accounting terms, we're not going to be crediting a 40%.
We're gonna debit the 40%.
We're going to debit the 40%. Good. So this is exactly what we're going to have, okay? We're going to recognize the cash that we're going to be receiving from the customer, right? We're going to also recognize that we need to record the discount because in our records, we need to keep track of where our money goes. So remember, we talked about sales, right? Sales will always be the same. So if you have a set price, it's going to be calculated at the set price, okay? So think about it when you guys go to the store, right? When you have something that's on sale and you notice that everything's going to be charged at regular price, and then right below it, you're going to see a line item that says sale or whatever it is, and it's going to have the subtract X amount of cents. So in this case, right, as an accounting, we need to recognize the sale as a whole entire value, right? And then we need to create our contra account because in this case, we're losing that money, okay? Because it's part of our profit. So we need to record that somewhere. And in this case, we record it in the contra account because this is what's going to reduce your sales, right? Your sales discount is going to reduce your sales account. So in this case, I need to recognize my 40% discount right here. And then, right, as you guys mentioned before, you can only charge tax on the items you actually sell. Or, I'm sorry, you can only charge based on the total amount of selling price that you sold. In this case, I did not sell 100 items. I only sold, $100. I only sold $60. So in this case, we are calculating sales tax based off of the $60 to give us the $4.95. So therefore, I should be receiving at the end of the day $64.95. So that is correct. So here is a good explanation, right? So when we do this, first thing that we got to do is, okay, we got to recognize our sales. If I sold 10 baseball hats at $10 each, my total sales is $100. Boom. Okay? My 40% discount, right? 40% of $100 means that my discount is going to be for $40, right? And what you're going to do is you're going to take the $100 of the sales, subtract out the $40 to get $60 because that's what you're actually selling is $60 worth of items. Then you're going to take that and times it by the 8.25% to get the $4.95. So excellent. All right. So that's what happens when we do discounts for in stores. Okay. So when we have a grand opening or some kind of promotional sale that week, this is what we're going to journalize. Okay. Now to the customer, they just bring it up to you and they'll just say, go ahead, what is my total amount? Okay? But it is written on the receipt exactly like this, right? You have the amount of cash that they gave you, you have the amount of sales in full price, plus the discount item on there, plus the tax that you're going to be charging your customer. So this is it. All right. Any questions here? Okay. So let's go ahead and take a look at sales discounts when people make purchases. So in this case, we're going to be giving terms. All right. So first thing here is, right, well, hold on. Let me go back to that slide real quick. This one, okay? So good, we understand that you're going to be discounting your original selling price. You can never, ever, ever, ever discount any freight, any shipping cost, or any sales tax. Just a little FYI, right? We all know this, right? Every time we go to the store and you take a discount, we always say, "Oh, it's like we don't pay any tax." No, you do pay the tax. Your items are discounted, okay? Just a little FYI there. Okay? So therefore, let's take a look here. This is where we have a customer that is going to be placed on an account. Okay, so they're going to be buying us on an account. So in this case, let's take a look here on July 1st. A customer wants to buy in bulk 100 baseball hats from your store, okay, on an account, right? Okay, so this customer, okay, is a first-time buyer and you want to offer them, an account, okay, and you offer them terms as well if they pay within 15 days, they can receive a 5% discount. If not, the whole entire bill is due within 30 days. All right? Each hat costs $10 each. Right? Sales tax is 8.25%, and the delivery charge is $10. Okay, so how are we going to record this transaction? So in this case, right, we're placing it on an account. We only give them the discount if they make a payment. So right now, I'm only focusing on them buying stuff from my store. So let's go ahead and record this transaction. How do I record this? Anybody want to try it?
I'll try it. Okay, so you said they what did you say about we're only charging them for what they bought from the store?
Right.
So they bought in bulk
Mm-hmm.
100 baseball caps,
Mm-hmm.
baseball hats from your store. Because he's a first time buyer. So first we'll put the date, we'll put the description.
Okay.
100. So he bought in bulk. So what he bought, one bulk for 100.
He bought 100 baseball hats, and they originally cost at $10 each. Each hat costs $10
10
each.
cups.
Yes.
So 10 times 100, that's $1,000.
Okay.
So you're gonna credit the 1,000,
Good.
and if he pays within 15 days, he'll get a 5% discount off of the $1,000.
Correct.
If he pays in 30 days, he'll have to pay the whole $1,000. So
Yes.
each hat is sold at $10 each, and so sales discount purchase.
We are not right now. We're only recording that they bought something from me.
Okay.
We'll talk about them paying in the next slide. So in this case, I just want to record what happened. I sold something to a customer, right?
Right.
So if I sold $1,000 worth of baseball hats, what else do I need to include?
The tax, the
Okay.
8.25% in tax, right?
Which,
So what you want to know, the price?
yes.
So it'd be 1,000 times the 8.25%, $82.50.
Correct. What else did we do?
So you said we're just gonna, you're not you're not putting it in the description. So I don't. And so
I'm waiting for you to go ahead and just elaborate everything, and I'll go ahead and display the answer.
oh, and I'm waiting for you to write it down as I'm saying it, so I can see it. But I don't know. So what else do we do?
What else did we do?
Question. So the total cost out the door right now before the 5% is $1,082.50. Correct?
What else did I try? What else did I?
But if they only get the 5% is only applied if they pay within the 15 days. Correct?
Correct. Right
So,
now,
and that's exactly where I'm done right there because I how to put it in there, but I know because and then anything after 30 days they have to pay full price.
correct.
Okay, so I'm just gonna wait for you to get an answer on that part because I'm caught up to right there.
I am
Perfect.
too.
All right. What else did I charge the customer?
Delivery.
You charged them delivery
Oh,
for $10 because maybe you didn't have all 100 items at the store, so they said, "Okay, well, just ship it to my house." Okay, you have to pay $10. Okay. Now, how did my customer pay me?
He paid in cash.
No.
Now, did he pay me in cash?
It's an
It's
account
fine.
credit.
So
it's account company store credit.
Good. In this case, what do we call that to? What account do we associate customers owing us money?
is that a contra account?
Not a contra account.
Accounts payable.
Not accounts payable.
No, receivable on this case.
Accounts receivable. Okay, so that's a term that you guys need to know is that when every time a customer decides to buy something on an account, it's going to be an account receivable, right? It's them saying I owe you money. Okay, so we're looking at we're the person that's selling the items, right? This person is a customer to us. They owe us money. So that's exactly what this is, an account receivable. Right? So everything you said, you guys were correct, right? We're going to calculate our sales to be the $1,000, right? Plus our tax of $82.50. And on top of that, we charge a delivery charge of $10. So here, my total amount is going to be $10.92.50. Okay? So this is just recording that a sale has happened. Now the terms only come into play when either the customer decides to pay for their money, pay for their bill, pay what they owe us. Okay? So that's what things here is terms have a condition. Terms only is applied when a payment is made. So in this case, we're just recording that a sale has happened, and this is exactly what happened here. I sold to them 100 baseball hats, and that's it. Okay? So now, fast forward, it is now July 12th, right? Which in this case, we made the discount period, right? So here, now the customer decides to pay their purchase, okay, in full. Okay, so now let's go ahead and record this transaction. And the terms was 5%, 15, net 30. So in this case, right, they purchased the items on July 1st, so they made the discount period because they paid within 15 days. So how are we going to record the payment? Okay, now we already did the sales. Okay, we already did the sales, so there's no point to have to redo the sales. Now this is in context where they're making a payment. How do we journalize this?
We're assuming they paid in cash.
Well, yes. In this case, yes, it's cash or check. So either way, it's still cash to us.
So they basically with the 5%, they'll be getting what they'll be paying cash before shipment and taxes $950, correct?
Yes, before shipping and tax. Yes, that is correct. Right? And you figured that figure out by taking the 1,000 and multiplying it by the 5%, correct?
That is correct.
Then yes, you are on the right track. That $950 before tax and shipping.
So total they would pay would be $1,052.50. That's including the $10 shipping plus the $82.50 for the sales tax. Correct?
Now, if I'm gonna be if they get a discount from me, right, from me, which is the 5% discount, right? And can I charge them tax for the full $1,000?
No.
No. What do I have to charge them tax at?
The $950.
Correct. So in this case, I can't charge them for the full amount for the $1,000.
The tax now is $78.37.
Okay. So, okay. Good.
And then to add to that, you add the delivery charge, correct?
Correct. Of $10. Okay, so Inga, you are on the right track. Okay, we're gonna be receiving cash from them. Yes, go ahead.
So out the door, they're paying $1,038.37. Correct?
We'll have to see. Okay, because I see how you're calculating it, and that's completely correct. But let's actually take a look at this way, because you're basically going back to the very first one and just recalculating everything that should be, right? In this case, this is a lot more easier. Okay? So when we talk about this, right? We've already calculated because we already had the sales. So when we talk about looking at what the end result is if they make a payment, right? We know that they owe me $10.92.50, right? We know that they owe me $10.92.50. Okay? Now, of course, when we recognize the discount, it's going to be almost $50, right?
Right.
Because we take the 1,000 items times it by 5% to get $50. Now, how much tax should we actually give back if we're returning, or in this case, discounting $50?
Would it be the 1042.50?
No, no. Okay. So in this case, if I'm discounting someone for $50, right?
It'll be $4.13.
$4. Yes, correct. So in this case, right, we can just add those numbers in there to get the total amount of the 1038.37. So you did the longer way to calculate the same exact number that I calculated. But like I said, you were correct. You were dead on correct. Spot on. You did end up receiving 1038.37. That's correct.
And we do not record the delivery charge because it's already included on the accounts receivable portion.
Correct.
Okay.
Absolutely correct. So in this case, right, when we're looking at the accounts receivable, we've all, in another sense, let's look at it this way, okay? I've already charged my customer this. I've already calculated my sales tax to be this, right? Because they receive a discount, just like how we do purchase return, how we did sales returns and allowances, you have to give back a portion of their money as well as give back the portion of the tax back. Because in this case, they received a discount. You have to give them back their money. All right? And in this case, they didn't pay you, so in this case, it's gonna counter against the accounts receivable, because in this case, we know exactly what they owe me, right? But however, when we credit our accounts receivable, they no longer owe me money anymore. They are paying me for what they owe. And in this case, right, we're going to include the discount because they deserve it. And we're going to also include the amount of tax that we originally taxed them for. So as you remember, right, you said I'm going to do $950 and tax them at 60 or 80, what was it? $82.50, right? No, you cannot tax someone for the full amount if you're going to be charging them for $950. Therefore, you need to decrease it, which then you went about and you calculated to be 78 something, right? So that's right here. Your difference would have been $4.13. Okay. Any questions here? So this is what happens when a customer decides to place everything on an account, and because we gave them terms and they make a payment to me, this is what I'm going to record. I don't care about what I sold to them because I've already recorded it. We're talking about the payment here, because when terms are given, the only idea here is that it has a condition. A payment must be received in order for your terms to apply. Okay? And I want to show you this because this is also technically considered a sales discount, because we sold something to a customer, they met the terms, so therefore we need to calculate it as if it is a sales discount because we promised them that they can receive a discount, but we gave them a condition that they have to pay within 15 days. All right. Any questions here?
I guess where this could get a little twisted in my head. I don't know about for anybody else, but because we're not able to do too much to the taxes, we still in essence, I mean, going the way that you're doing it, recorded it and everything.
Mhm.
But why wouldn't we just include the taxes after the customer has initially made their payment versus recording it at the top of what the full amount is? You understand what I'm saying?
Be, be,
I do.
because this is what the original was. right? Because if let's say they pay us after the discount period, then they owe us a flat 1092.
Right. But then in essence, on the other one, we still went ahead and discount the taxes as well. And not just the total amount for the sales before shipping and taxes. We discounted the taxes on the other ledger, did we not? For the the difference was the $4.13. So we still discounted the taxes. I thought we could not do that.
In this case, you okay, you didn't take 5% off of the tax. That's what I mean by you can't discount tax. You're not taking that 5% and applying it to the tax, which was originally for 82.50. Go ahead and calculate that real quick. What is 5% of 82.50?
$41.25.
41.25. Exactly. You're not, in this case, we're not discounting
The taxes.
the taxes. We're giving back because that's not money that we owe. That's not that doesn't go towards our sales. That's not our income. That's money that they placed in to give to us because they want to buy a product from us. That is what the government is taxing customers, not us. We're not doing it. And then as a righteous person, if they returned a product or sold something or got a discount off of it, we have to charge them for the correct amount because in this case, right? Customer could come back at us and be like, "You didn't give me back my money for my tax." And then you would also be in trouble there. So, once again, tax is not our money. It's the customer's money. All right? And if the customer pays into the tax, we're responsible to pay it towards the government. That money is not ours at all. Okay? So if we have a duty to give them a discount or give them their money back, right? So that's why I said in this context, when we do terms, it's as if you're treating it like a return and allowance, right? You have to give them their money back because when you recalculate it, just exactly how you did it, right? You took the discount off of the original amount for $1,000 to get $950. You can't tax at $1,000. You have to tax it at $950 because that's just the law. That's how sales tax works. And if the customer, ends up donating that $4.13 to you for any reason, then yes, you can pocket it. But in this case, no, we have to calculate the portion correctly because that's what the government is telling us to do. In this case, we're not discounting the tax at all. Because we discounted the original selling price, we are obligated to adjust the sales tax here. Okay? I don't know if that makes any sense.
I got it. I understand.
Okay.
Yeah, I got it too.
All right. So it's not what we calculate. It's not what we're not giving them. It's what the government is mandating us in order to sell this product. Okay. So there we have it. And that's it for this chapter. So chapter 6.1.2 and point 3, right? We got to take a look at how we compute sales. How do we journalize sales? So in this case, this example here, there's no sales tax. But most cases, if you are having a retail store, an actual location, you are obligated to charge sales tax to your customers. So how do we journalize it? Well, it depends, right? Did the customer give me cash or did the customer charge on their account? Okay. We also took a look at what happens when we have a returns, right? We must count for the returns, and if it's for a full refund, we give them back their money plus the tax, okay? But if we give them a discount, right, and say, no, we can't give you back your money all the way, we'll give you an allowance, then you're going to calculate what the return is for. Then you're going to multiply by whatever percentage discount you gave them, and you're going to journalize it exactly like this, okay? And you're also going to give back the tax if there is any, okay? Then we also talked about the difference between the sales discounts, right? In-store is pretty straightforward because at time of purchase, usually most commonly, you will see that they will get the discount right then and there, right? Because in-stores sales, right, the discount is effective immediately. Whereas terms, right, we talked about terms. Terms has a condition. The terms is that you give them a condition to give the incentive for your customers to give you back their money quicker. So again, most cases that people that have accounts are the most likely the ones that are going to be given terms. So again, we record the sale first, and the condition is that if they make a payment, then we either determine whether they get the discount or not. Okay? All right, so let's go ahead and dive right into the very first exercise here. So exercise for chapters 6.1 through 6.3, periodic inventory sales. Let's get started. So first things first, right? On April 5th, you sold 100 cups at $5 each, right, to customer A for cash. Now let's assume sales tax is 8.25%. So how are we going to journalize this transaction?
We have a cash for 500.
Good. Okay, so cash, we're going to recognize cash because we received cash from customer A. Okay.
All right, and that is good for 500.
Okay. There's one more thing that you're forgetting for this transaction, right? I said, what about the tax?
Yeah, sales thing. We have sales, right?
We have sales. Yes, we do have sales tax because I said assume that sales tax is 8.25%.
Yeah.
So we are charging our customers sales. We are charging them tax, yes.
Sales tax.
Okay, so let's go ahead and calculate our amount. So you said $500, right?
Yeah.
Okay, so, right, we take 100 and we times it by $5. So in this case, $500, right? How much is tax?
$42.50.
$42.50. So in grand total, how much cash are you actually receiving from customer A?
542.50.
Okay. And if you want to put a note here that you sold to customer A, you can do that too. I could say I sold 100 cups to customer A. Pretty straightforward, right? Perfect, journal, perfect, good. Okay. Now then, on April 7th, you sold 25 cups for $5 each to customer B on an account. And you gave them terms 10% if they pay within 15 days. If not, the whole bill is due in 30 days. All right. How are we going to journalize this?
So first is gonna go accounts receivable
Mm-hmm.
and
Accounts.
sales tax payable.
Good. So accounts receivable. You got sales in sales tax payable. Okay, so what is my total amounts here going to be? Okay, let's start with sales. We sold
125,
100.
50, no, $5 times 25 is 125 under sales. Correct?
We sold 25 cups at $5 each. Yes, 5 times 25 should be 125. Good. How much tax am I going to be charging?
Is it 1031?
I
And I do that by multiplying 125 times 0.0825. And I got 103125.
Perfect. All right. So then in grand total, how much does customer B owe me?
$135.31.
Good. All right. I'm also going to make a note here that I sold 25 cups to customer B. Right?
And then note the terms also.
Correct. I'm
You
going
know
to
the
go,
terms?
yes, I'm going to go ahead and do that. Yes, because then when I go through my transactions, I can at least refer that, okay, yes, I give my customer, right, 15 days. Is it 15 days? Let's see. I gave my customer B 15 days to pay me back. If not, the whole thing is due in 30 days. So they get a 10% discount if they pay within 15 days. So I do 10%, 15, net 30. Right? Good. So then what happened on April 10?
You purchased, or you sold, sorry, 50 cups at $5 to customer C for cash.
Okay. So we sold another.
We'll have cash as our debit,
Okay.
and then we'll credit sales and sales tax payable.
Good.
The sales will be $250.
Give me a couple more seconds. Okay. So sales was $250, you said?
Yes.
Okay.
And the sales tax is $20.63.
Okay.
And then the cash debit is going to be $270.63.
Good. Excellent. All right, and here I will also make a little small note here that I sold. How many cups did I sold to them?
50.
We sold 50. Okay. We sold 50 cups to customer C. Right? All right, so let's go ahead and see what happened next. Oh, I gotta change the date. So here, what happened on April 15?
Okay, on April 15, customer A returned 10 cups for a full refund.
Mm-hmm.
So they get back $50.
They get back more than $50.
Wait, 10, they're $5 each. 50 cups at $5 each.
Okay, so are they? Oh, sorry. You said more than $50? No, it's less than $50. But in this case, how many? You said 10. 10 there,
Oh,
okay, hold on. Let me see.
we're on
Okay, so
April
customer.
20th. We're on April 20th,
We're on April 15.
15th. Okay, so they returned 10 cups, and the cups are $5 each
Okay.
for a full refund.
Mm-hmm.
So 10 times 5 is 50, right?
Okay, but they're getting a full refund. So
For
there's
the
a
10, for the cups, right? For the 10 cups,
yes, correct.
$50. Okay.
But what else do you have to give back to the customer?
The difference in the taxes.
Yes, you have to give back their taxes because they paid into it. You can't keep it. That's not even your money. So in this case, what account would I be using to record
Sales
this
return and allowances.
sales returns and allowances? Good. All right. We also recognize that you have to give back a cut of their sales tax that they originally gave us. So in this case, how much tax do I have to give back to my customer?
I got $4.13.
$4.13. So how did customer A originally pay me?
Cash.
They paid me in cash, so therefore I'm gonna be giving them back cash. All right. So in grand total, how much cash am I gonna be giving back customer A?
$54.13.
$54.13. All right. So here, I'm gonna make a note real quick saying that customer A returns 10 cups for a full refund. Okay. So then let's see what happened next on April 20th.
Customer C returns 25 cups, but is willing to accept 15% discount.
Okay, so how are we going to calculate this one? So April 20th. They're going to be getting an allowance, right?
Yes.
Okay, so we should. What was that, Nathan?
What was the percentage they gave it discount? 25%?
15% discount. So sales returns and allowances, right? So they're trying to return, or they attempted to return 25 of those cups, but somehow I convinced them to keep the cups, and they're willing to accept a 15% discount.
$18.75 is the discount.
Okay, how did you figure that number out?
125 times point 15,
Okay,
which is how do I get a 125? I think half. What was that? 25 times 5, right?
25 times 5. Excellent. So 25 times 5, right? You get 125, and we're only calculating 15% because that's how much we're going to give the money back because they've already paid already, right? We're just giving them a 15% discount. So we're giving back 15% of what they originally gave me. So in this case, what did you say was
75.
1875? Okay. What else do you need to give back to them?
Taxes.
You got to give them back their tax.
Okay, I'm sorry. The sales returns allowance, so we multiplied,
So
uh,
25.
times 5, and then from that we took the 50%, and that's the 1875, correct?
Yes.
Okay, thank you.
So 125 times 15% is $18.75. Right? What's my tax off of the 1875?
$1.55.
$1.55. So how much? Well, before I jump over myself, how did customer C pay me?
Cash.
Cash.
They paid you in with cash. So therefore, how much cash am I going to be giving back customer C?
$20.30.
$20.30. So once again, I'm going to go ahead and make a note. Customer C received allowance for 25 cups at 15% discount. Okay. Good, excellent. So, last but not least, on April 22nd, customer B decides to pay for his purchases and meets the discount. So, excuse me, I misspelled discount. So what was his discount for?
%10.
10%. So in this case, he purchased it on the 7th, 15 days later, which is exactly on the 22nd. So he made the discount period. So in this case, right? He placed it on an account. And now he's paying us for what he owes. So he should be receiving a discount for 10%. So how are we going to journalize this? We're going to be receiving a payment from customer B.
So we're assuming he's paying cash, so we can just put cash.
Good.
Sales tax also.
We're also going to be giving back some sales tax. What else?
Discount.
We got to also record the discount. Good, because they get the 10% discount. Okay, what else?
We're gonna credit accounts receivable.
Right, we're going to credit the total amount that customer B owes me. So in this case, right, let's take a look. How much was the amount that customer B actually owed me?
135.31.
135.31. So that's automatic here that the customer owes me 135.31. But because they meet terms, right, they get to take a discount, right? So let's go ahead and go up and take a look at the original purchase itself or the original sales itself. So in this case, right here, how much was the original sales?
125, 10%.
Is how much?
125, the original sale.
Good.
25, so times 10%.
All right, so $12.50 is going to be the discount. Excellent. Okay, so the discount, right, is 10%. 10% of 125 is $12.50. Now, we originally charged them the full tax, so we also have to give back a portion of their tax because we're giving them a discount amount. So how much tax? Go ahead.
$1.03 will be the tax.
Right. How did you figure that number out?
Yeah.
Multiply the 1250 times the or the 8.25%.
Good. So, how much cash should I actually be receiving?
$13.53.
121.78.
Okay, that's the total. That's the total discount plus the tax that I am taking away from what he owes me. So the total cash, right? If I take my 135.31, I subtract out my 12.50 because that's my discount. I subtract out my $1.03 for my tax. Therefore, I should be left with 121.78. 78. Good. All right. And I'm going to go ahead and say customer B pays in full, received 10% discount. Okay. Good. All right. So once again, we will practice this more as we dive into our fictitious business because, yeah, like I've mentioned before, all of this is things that we're just looking at a slow, like we're just looking at them one step at a time. So any questions in regards to chapter 6.1 all the way to 6.3?
No.
Okay. So right now it is about 10:15 or about 10:15. So let's call break at 10:15 and let's take a 20-minute break.